welcome to the Money Show right here on ET Now. I'm Avan Dabash. This is the only show of its kind where we get you top personal finance experts answer all your financial and mutual fund related queries. Well, it's just a few days away from the brand new year, so today over the next half hour, not just answering your queries, we'll also be telling you what you should watch out for in terms of the best mutual funds for the coming year. Do remember, this show is dedicated to you, the viewers. So if you have any questions through the course of the next half hour, please pick up the phone and dial in. There's a number flashing at the bottom and the top of your screens constantly. And you can also email us your entire portfolio or questions on the Money Show at etnow.tv. Well, Feroze Azeez is the Deputy CEO at Anand Rathi Private Wealth Management, and he now joins us live on the Money Show. Great to have you on board as always. Wishing you a Merry Christmas, but it's been anything but merry for the equity markets, Feroze, when it comes to the year 2018. So let's crystal gaze, look forward to the next year. It's going to be lined up with quite a few volatile events such as the elections. We're going to be monitoring global crude oil prices, etc. Tell us, for the next year, which are the top recommendations in terms of mutual funds and what's the advice?
Hello Avan, and Merry Christmas to you as well. I think it's very important when you're looking at mutual funds and understanding that the underlying instrument are different company shares. So if you're being given several basket of shares, it's important to understand the inherent value and the potential of those basket of shares. So at Anand Rathi, we basically go stock by stock in each portfolio of mutual fund and try and see where is the maximum potential for growth, and we try and look at the forward. We are more forward looking than just the rear view mirror, like you just said, the crystal ball gazing attempt. So Kotak Standard Multi-Cap, which is a large fund from the multi-cap side, which can invest in different kinds of sizes of companies. That's one of my picks. Harsh Upadhyay is the fund manager, upwards of 20,000 crores. I think even after that kind of size, it has not impacted the performance, and I think it will still remain contemporary for the next 1 year, and it was recommended a year back as well. So that's one of them on the multi-cap side. Then you have Reliance Large Cap, a little offbeat recommendation, not a very large fund. Of course, 11,000 crores is a large fund, but not the really large like the Kotak Standard Multi-Cap. That's my second choice. Sailesh Rajbhan, old-time veteran with Reliance, is the fund manager. I think it's a little higher on the volatility, but it has large cap stocks, so that also tries to mitigate risk. So it's a balance between risk and mitigation as well. So that will be my second pick on the large cap side. The third would be Kotak Emerging Equities, fund manager Pankaj Tibrewal, a small fund of 3,300 crores, which is optimal for a mid-cap kind of a space. And I think that bottom-up stock picking Pankaj has very well shown in the last 4-5 years, and that's why it would be my bet. And HDFC small cap Chirag Setalwad, he needs no introduction. He has done a great job, and that's why small cap fund has managed garnering 5,700 crores of assets. So that's my fourth pick. And the last one, which is again an offbeat fund, SBI Focused Equity Fund, a category which was recently carved out as latest as April 1st, 2018, which is focused equity, where there are fewer number of stocks. This has about 22 to 24 stocks at a point in time, managed by Srinivasan, one of my favorite funds for the last 1 year, and especially focused category is something which is under-penetrated. So these 5 funds from different categories of mutual funds can come together to make an optimal portfolio of one.
Hey, there you have it, a menu card really being spelt out by Feroze in terms of all the top funds that he's bullish on. Well, our phone lines are already buzzing, so let's connect with our first live caller. Rohit is with us from New Delhi. Hi there, Rohit. Welcome to the Money Show. Good evening. What's your question?
Yeah, good evening. I'm a 47-year-old. I'm a central government employee.
Okay.
And primarily I have a question regarding my retirement corpus.
Okay.
I have started investing in SIPs this August only. That is primarily for the retirement corpus. Whatever I had to accumulate for my children's education, that I've already done with.
Okay.
So there are 5 funds in which I am investing 50,000 rupees currently in SIP.
Okay, which funds?
The first one is ICICI Prudential Nifty Next 50 Index Fund.
Okay.
And Kotak Standard Multi-Cap, Mirai Asset Emerging Blue Chip, Parak Long-Term Equity, and SBI Small Cap.
All right, let's review that portfolio then, Feroze. Your take?
So I think he's investing in 5 funds, 50,000 rupees each. The first one, which he just spelt out, I think that's an exit. Why is that? Because you're looking at the third one, which is Parag Parekh. I would look at my equity assets to be managed by the top asset management companies as a thumb rule, and data throws up very clearly that focusing on the top equity funds, asset management companies especially, for your equity management is a better idea than going into the smaller asset management companies, because the infrastructure, the capability and the analysts are fewer in number, and I would definitely bet on the top 7-8 asset management companies to manage my equity portion. Kotak Standard Multi-Cap is a very good fund. SBI Small Cap, I think you've invested from looking at the past performance of 2016, 17 early part, but I would definitely recommend you to move to SBI Focused Equity under the same basket. These are the minor changes which you should do. And I think, Rohit, importantly, like you spelt out, that retirement is an important objective. Most of us end up neglecting it, but there's nothing called a retirement loan, so we have to service ourselves for the next 20-30 years post-retirement. So it's important to place emphasis to this objective, and I think inflation is going to be a big silent killer for the monies accumulated for retirement. So it will require extra effort on an individual's part to be able to catch up with the mehengai, or the price rise as we call it.
Alright, I hope you've taken note, Rohit, of all of the rejigs in your portfolio, and we were able to help you out. Well, we have a whole host of questions as well emailed to us on the Money Show at etnow.tv. So let's get straight to the first email query. Mahindran Govindan has said, I'm 63 years old and a retiree. I have invested about 22.5 lakh rupees in mutual funds. My objective is to get a monthly income of 23,000 rupees and of course saving up for my retirement. Please review my portfolio. So there's a number of funds that he's got: the Kotak Standard Multi-Cap, Mirae Asset India Equity, Mirae Asset EM Blue Chip, Aditya Birla Sun Life Frontline, SBI Blue Chip Fund, Axis Dynamic Equity, ICICI Pru Balanced, ICICI Pru Equities and Debt, and the HDFC Hybrid Equity Fund. So give us a sense as to how you're looking at his portfolio. He's already 63 years old. He wants to get a direct monthly income. Is he putting his fingers in too many pies? And how would you look at his entire portfolio, Feroze?
See, I think, Aman, the portfolio of course has 9 equity funds. Largely most of them are equity and balanced funds. Firstly, if you're a retired person and want a regular income or one source of kind of credit to your bank account, it is wise to not have all your money or large portions of your money in equity. 40-50% will have to be in debt to bring that stability in the portfolio, and your return expectation is 1% a month, because if you have 23 lakhs and you have a 23,000 rupee requirement, that's a 12% per annum kind of a return expectation which you have, which I think can ideally be fulfilled with a combination of 50 in equity and 50 in debt. So that's point 1, asset allocation. Point 2, when you're retired, your scheme choices have to be far better, because if you are in worse schemes or bad schemes, and then your performance will be dragged, and your retirement corpus will not be able to furnish the expenses which you expected to do. So that's point 1. So your 9 funds require a lot of change, in my opinion. So what those changes are: ABSL Frontline Equity deserves an exit, SBI Blue Chip you should exit, Access Dynamic Equity, ICICI Balanced Advantage Fund, ICICI Equity Pru Equity Fund and Equity and Debt, hybrid HDFC Hybrid Equity, and invest this money in Canara Robeco Emerging Equities. It's very important. And you can also look at Reliance Large Cap. So this 5-6 funds which I spelt out need to be converged into 2 funds, to my mind, because you've scattered your money a little more than you should, just like Awan mentioned. So you should converge it to these 2 schemes. And last piece of advice, which I think is very important for anybody who's looking at retirement: buy yourself a liquid fund and do a systematic withdrawal plan to take care of your recurring expense, rather than taking dividend option in all equity funds and debt funds, which is a far expensive affair from a taxation standpoint. So third piece of advice is put 3 lakhs in a liquid fund, maybe a Reliance liquid fund. Take a systematic withdrawal plan, also abbreviated as SWP, to get the 23,000 credit, rather than trying to get a dividend on the entire 23 lakhs, you're better off carving out a second portion out of your 23 lakhs into a liquid fund and then taking a systematic withdrawal plan to bring consistency into the inflow to your bank account.
Alright, that's the take coming in terms of rebooting and rejigging your entire portfolio. A lot of changes have been made, but by and large, Feroze is stressing on the point of allocating close to 40 to 50% of your savings in debt and the rest in equity. Do remember, our phone lines are open. If you have any questions for Feroze Azeez regarding your mutual fund portfolio, please do dial in. Alright, let's take on board our next email question. It's been sent in to us on the Money Show at etnow.tv from Kamal. He says, do you think that with the market volatility in certain sectors outperforming, one should look at sectoral funds for 2019? And a valid question, we have big events lined up for the next year and we're expecting it to be, the markets really to be infused with quite a bit of volatility. So in light of this, what is your take, Feroze, on these thematic or sectoral funds? What are the pros? What are the cons? Should they be looked at?
So Aman, I think it's a very interesting question, a very valid question, because a lot of people actually get lured towards sectoral funds or even thematic funds. Point one is your core portion of your portfolio should only comprise, core portion should comprise of large, mid, small and multi-cap. These are the four categories which are relevant to you from a core portion perspective. If you have exhausted your appetite for the core portion, then you can get into the peripheral funds like a sector fund. So point one, don't venture into it unless you have a core portion of your portfolio ready, and most people end up starting with a sectoral fund, which I think has not too much rational or a good thought process before building the portfolio. That's point one. Point two, if we are guided by mathematics, and we should always be and not go by impressions and perceptions, mathematics clearly says that sector funds take 50% more risk than Nifty does, and the return generated over long periods of time converges back to a large cap fund. So if you are not a very active investor who will go in and come out, and getting out of a sector fund is as important. So point two I'm making is the risk taken is significantly more than a large cap fund, but the return in the long run converge back to the large cap fund. So point three is if you're a short-term investor, you can enter and then exit the sector fund. Then maybe you will get some extra return if you get it right most of the time. And if you are anyway supposed to be a short-term investor, I would rather use a direct equity platform than a mutual fund to create trading profits from a sector. That's my take. So I would definitely recommend otherwise, and I don't think you will miss much if you kept them away from your portfolio for the next 10 years as well.
Right, there you have it. That's the take coming in on your entire portfolio. What exactly you should do with thematic funds. They're concentrated funds. They have exposure towards a particular sector. So open-ended diversified equity funds would be a preferable option. Well, let's connect with our next live caller. Shreya is with us from Mumbai with a question for Feroze. Hi there, Shreya. Welcome. What's your query? Shreya, are you with us on the phone line? Oops, we seem to have disconnected that phone line. Nonetheless, please keep your questions and queries coming. You can dial into the number. Do retry if you haven't gotten through in the first shot, or simply email us on the Money Show at etnow.tv. We take a quick break. Feroze Azeez is with us answering your questions and giving us a view on our fund review that's coming up next. Welcome back. This is the Money Show. We're in conversation with Feroze Azeez answering all your mutual fund related questions. Let's move on then and focus in on Jan Nivesh. That's Times Network and Amphi's initiative, an investor education initiative. We're getting people to pledge to invest at least 1 day's income into mutual funds for long-term benefits, and you too can be a partner of the Indian economy. It's growing by investing in mutual funds. All you have to do is give a missed call to be part of the Jan Nivesh movement. 1-800-833-666, and there you have However, the numbers really tell the story. 10 lakh Indians are chasing their dreams with Jannivesh, and you can too. And in fact, in that vein, let's connect with some live callers who have queries for us. Arvind Kumar connects from New Delhi. Good evening, Mr. Kumar. What's your question?
Hi. My name is Arvind. I'm 31 years old, and from mid of 2017, I'm investing 35,000 in my mutual funds.
All right.
And my funds are, I'm investing 10,000 in Mirai Research Mutual Fund,
Okay.
and 15,000 in Mirai Emerging Blue Chip Fund, and
Okay.
10,000 in Motilal Oswal Multi-Cap 35 Fund.
Okay, fine.
And also I'm investing for my tax saving 10,000 per month in Access long-term equity fund. Now my question is this portfolio can fetch me 16 to 17%? It's basically for the 15 years period. And also, should I change Motilal Oswal in the fund, or should I keep it as it is?
All right. So let's understand if for the next 15 to 16 years, for the long term, he can make a steady return. Motilal Oswal multi-cap, what's the views particularly on that, he asks?
I think Motilal Oswal had a larger weightage towards financial services, and financial services in 2018 haven't done too well largely, so that's why the underperformance. The concept of focused equity is good. Motilal Oswal is a good fund house. You can definitely stay the course, but on the other side of the portfolio, I'll definitely give you advice: 50% of your money or even more in one asset management company, both Mirai funds, I think doesn't make sense. So you'll have to look at some other asset management companies as well. For the amounts you've accumulated already, just stay put, because Mirai is a very good Korean asset management company who has done justice to investors' money ever since it's been in India. So nothing against Mirai, but having 50-60% in one asset management company on the equity side doesn't make sense. So move on to some other asset management companies, especially on the larger side. SBI Focused Equity is a good fund because you very clearly indicated that you want a higher return. So focused equity could be one category you can go after, and different asset management companies is the one piece of advice I'd definitely leave you with.
There you have it. That's the take coming in with respect to your entire portfolio. Samir Jain is with us from Kolkata, and we're taking on board his question as well. Samir, welcome to the show. What's your query?
Yeah, good evening. This is Samir Jain from Calcutta. Basically, for last 2-3 years, I have invested in PMS of Motilal Oswal, AIF of IFL, and Motilal Oswal AIF private equity. But the thing is that for last 2-3 years, the investments are not giving return to me. Shall I exit all these investments, or shall I stay for 1 or 2 years more?
Feroze?
Hello.
Yeah, stay with us, Samir.
See, I think Mr. Jain, I definitely. So, Mr. Jain, I think whatever you mentioned, PMSs, AIFs, I've personally seen that the risk PMSs take in the form of standard deviation is significantly more. PMS's standard deviation, which is a measure of risk, is 50%, if not more, than Nifty. So I don't recommend PMS, and at Anand Rathi we've banned PMSs for the last 6 years. So point one, you should exit PMSs, use the mutual fund platform, which is more transparent. In fact, Motilal Oswal is a good fund house. You should move to their own equity mutual funds, which are equally good. Point one. Alternate investment funds, to my mind, again have taken flavor because mutual fund commissions on the other side have come down. So I am not a propaganda of AIF either. You can keep your life simple. Mutual funds have delivered a risk-adjusted return, which is significantly better. Of course, they don't have the glamour quotient, because even a 5,000 rupee investor or even smaller can invest. But I think glamour quotient is not the objective. So these exclusive products, to my mind, other than structured products, we have not recommended. But I would say that you should exit these and make sure that your cost and tax implication is low. And if so, whenever it is, move to mutual funds and use some other product category, but not an AIF, to my mind.
I hope that cleared your doubts and answered your question regarding PMS. And do remember, if we can't take on your live calls, email us on the Money Show at etina.tv. Amit Goswami from our ground event at Jannivesh asked a question. He says, what is the best scheme for a fixed salaried person with a good interest return? So essentially, what are the recommendations?
Sorry, Avan, I couldn't hear you clearly.
Okay, this is Amit's question. He sent an email saying, what is the best scheme for a fixed salaried person with good interest return? You've recommended a number of funds, debt funds. What's the view?
Okay, perfect. So if you have a fixed salary and you want a fixed return, interest income, I think debt funds have a lot of different categories. You should stick to a fund category called accrual funds. In that, if you're young, Amit, I think you can also take some degree of credit risk. Use the credit risk category, which will give you that 2% more per annum. So recommended fund would be Franklin Templeton Dynamic Accrual Fund, ICICI Credit Risk Fund. These two funds and even an Aditya Birla Credit Risk Fund have net YTMs. Net YTM, by which I mean the net interest post expense, upwards of 9.5. So please lock in that interest. I don't think interest of this quantums will sustain for long periods of time. So use these three funds because you have three and it will be diversified enough to mitigate the credit risk to a certain extent. So that's what my recommendation would be, Avan.
All right, there you have it. That's the call coming in. I hope we answered your question. Those are some funds being recommended. Let's get on board. Our last caller, Vivek, is with us from Bengaluru. Good evening, Vivek. Welcome to the Money Show. Go ahead.
Yes, I'm a 40-year-old individual. I have 15 years ahead of me for making a corpus for my daughter's education. What I would like to know is which are the top recommended funds and what is the percentage split on those?
What's the time frame?
15 years.
Okay. So for his daughter's education, what should he be looking to put his money in, Vivek, Feroze?
Correct. So Vivek, I think definitely 15 years is the kind of time frame you have for your daughter's education or marriage, which you are trying to save up. Then you should look at large portions of your money getting to equity, especially in the current situation. Of course, elections around the corner. Still focus on equity because it really not matter 15 years down the line what happened in this general election. So let me give you SBI Focused Equity, which is a good fund. Reliance Large Cap, Canara Robeco Emerging Equities, Kotak Emerging Equities. These could be the four funds on the mid-cap and the focus category. And then on the multi-cap side, of course, you can look at Kotak Standard Multi-Cap. Use these five funds. You can add a sixth fund, which is going to be on the debt side, which is Reliance Credit Risk Fund. So these six funds put together in equal proportions should be a reasonably stable portfolio to deliver 13 to 14% in the long run, if not more.
You've got some top recommendations and you've taken note of all of the funds that Feroze has recommended. Feroze, you've been a great help, I'm sure, to all of our viewers. Thank you for connecting with us and being with us on The Money Show. And to everyone that's watching, email us your questions on themoneyshow@etn.tv. Thanks for watching.